Okay, you guys, this webinar is on long calls, and there is always an opportunity to put on long calls, you guys. Maybe not in the crazy markets we've been seeing today. I wouldn't say necessarily tomorrow, necessarily go out and implement this, but it is something we need to be very aware of because, when you are dealing, especially with a margin restraint or anything of that nature, like you might very well be on margin restraints and stuff like that with a smaller portfolio, or if you want just a more diversified portfolio. I'm going to talk about how long calls are a great substitute for even just going out and buying the stock. I read your tweet on the Corona scare. Yeah, thank you. Well said. Thank you. Appreciate that. I mean, we can talk about that here in a minute. I actually, that's another reason why we got run over here is because I was talking back and forth with the guys at the office about this and how I think it's just a little overblown at this point. If you think about it, coronavirus, you guys, 2,000 people have died globally. It's the people that have died are elderly and people with major health issues already. Yes, it is more contagious than the common flu, but 3,000 to 5,000 people died monthly from the common cold, you guys. So it is a little bit blown out of proportion in my eyes. So, and I might be completely off my rocker, but at the end of the day, it seems a little ridiculous to me. All right, but long calls, you guys, we have a market correction. We just did the long puts, last protective puts. Hopefully some of you guys took advantage of that because the volatility explosion we've seen has helped those, even if you were directionally wrong, which, was, you would have had to be really lucky to be wrong. But you probably, even if you were directionally wrong, those puts have expanded in value. I'm short calls and some things, and the volatility expansion has almost counteracted the directional move to the downside. Yes, they're making a little bit, but not like what you would expect with these types of moves. So why it is really important when I'm talking about the environment and implied volatility, you guys, that's why I stress implied volatility so much. It's like I talk about it till I'm blue in the face, and it's because it's extremely important. So we'll talk about some of that as we go along, but this is going to be on the long calls. I'll go through strike location, why I feel like my strike location is better than what you find online in a lot of places. I usually am, getting ahead of myself here. Talk about the 35 delta is what I like to shoot for, 35, 45 delta, just out of the money. Now, a lot of people online will talk about buying the 55, 65 delta, and they think it's because, for every dollar move, you're getting, a better chunk of that move. And I'll show you how that doesn't really work out mathematically in a sense. Your risk reward just isn't there. So anyway, let me go over a couple of things real quick. My name's Eric Wilkinson. For some of you new people out there that may or may not recognize me from mainstream media, where I've talked about everything from economic to geopolitical and market analysis on those mainstream media outlets. I've traded my own money for about 28 years now, you guys, and I started out with some money I had earned since I've been working since I was like 13 years old on farms and stuff like that. So I got to college, deposited my money. The money manager there at the bank was like, hey, you want to invest some of these into some stocks? And I originally said no. I was going for a psychology degree. And after kind of flipping through the Wall Street Journal and looking at a couple of stocks, I decided to do that because otherwise it was just sitting there idle. So in that time, after graduate, I actually switched over from psychology to finance after I started really getting into it, selling some options around those stocks that I had, and decided to move up to Chicago after graduating to the Board of Trade, and started working on the floor ever since. Or I'm not working on the floor now, but started trading ever since. Anyway, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. I've even seen worse market conditions than what we are currently seeing. This is our new disclaimer, you guys. Please take a moment to read over this. And if you're watching this on TikTok, you'll probably have to pause it. But basically, this is stating we are an educational company, you guys. we are not trying to teach you guys or to get you guys to lemming off the cliff with us. All right. I'm not into the herd mentality. I think that you guys should be making your own decisions on your own accord. All right. You guys may have seen this market sell off come well before maybe I would have. You know, I'm thinking the coronavirus is overrated. Well, you know, I've gotten kicked in the teeth a little bit here the last 8 days. But at the end of the day, you know, you may have called that. So don't lemming off the cliff with me. I'm not into the herd mentality. I'm not trying to give you guys trade recommendations. I'm just telling you how I see it, and I will talk about my own trade. So whether or not you guys follow suit with that, that's on your own accord, and realize that you can really lose some money. You can follow me on Twitter at Wolfman's blog, or our parent company at ProTrader Strat. Also on our Facebook page, we put out a lot of content there, you know, daily market commentaries and stuff like that. Not all of them, but you get a few videos here and there. I see a couple questions, or at least something coming up here. It doesn't help when the news keeps showing big scary pictures of spores. LOL, that is true. It is more contagious for sure, but I think it's 4 times more contagious than the common cold. California seems to be monitoring 100,000 people of possible corona cases. You know, I'm not surprised. Where did you live before moving to Chicago? I was in Indiana. I lived in Indiana. I went to school at Ball State, and then just a couple of years ago moved to Arizona. All right, so a couple of things really important with this. Delta, it's going to affect the option premium for every dollar move that underlying makes, that first dollar move. So I'm going to pull up the platform here a couple of times, and we will go over and look at some, let's find something here besides gold. I guess TLT is probably not the best one. Let's look at Netflix. All right, so go to the 22 days just because it's a little bit easier. And we'll see here on this volume and open interest. I don't know why that's up there. Let's go to the delta. So we've got delta, gamma, theta, and vega. These are the ones we really are concerned with. Now, delta is this line here for the calls, this line here for the puts. You'll see that the puts are negative because I said for every dollar move, right, that the underlying makes. And it's assumed that all of these Greeks are a positive move, okay? That's just one thing that we have to know as a given. It's a positive dollar move. So if we look at Netflix for the first dollar move, $371.71. If it moves up to $372.71, that all these options are going to increase by the corresponding delta. So these right here are trading, let's just call it $18 for easy math. That first dollar move, it's going to be $18.52, right? These, like, if we just said the middle of the market was $17, that first dollar move is going to be $17.49. All right, so that's what it's assuming. Now on the put side, on that first dollar move higher, you can see that delta is negative. So a dollar move higher would be a +1 plus a negative equals, that's a negative, right? So these would subtract 46 cents out of the puts. Vice versa, we had down days, right? We look at the down days. If it moves down by $1, then it is a negative $1 and a negative 46. So that's a positive. So negative plus a negative is a positive. So that adds in here. And, you know, on a $7 move today, you're going to have quite a delta and gamma adjustment, which we'll talk about here in a second with the gamma. Now, think of it this way. Delta is data, all right? Delta gives you all kinds of stuff. It's probabilities. It's how it affects the premium. There's all kinds of things that go into it that I don't have the time. But think of delta as the data center, all right? Now, gamma just goes with delta. It's simple as that. So we talked about delta is that first dollar. Delta is, let's say, dollar number one, right? Well, gamma is basically dollar number 2. All right. So on the second dollar, it's the rate of change to delta. So you have to think about it. You're going forward. So $2. So gamma really came into play with the moves that we had today for sure, especially in that, one that was Netflix down $7. So if you think about it, the first dollar move, we said this went from $18 just to make math simple. It goes from $18 to, on that first dollar move, let me pull up a pen. So we went from $18 to $18.52. So that first dollar move, we went from $18 to $18 and what was it, 52 cents, right? So now we're at $18.52. The second dollar, so dollar number 2, we're looking at this gamma then starts adding into, gamma's this line, adds into that on that second dollar move. So that second dollar move, now we add in 53 cents to this. So now we're at $19 and 3 cents. 3 cents, right? Oh, sorry, 5 cents. All right, so $19.05 because we added in another 53 cents. So gamma goes with delta on the second dollar move is what we have to look at. Somebody's throwing out the coronavirus 8,000 cases. I'm assuming you mean globally. If you talk about the common flu deaths globally a month, we're talking 30 to 50,000 deaths, right? So now it still pales in comparison. Yes, they're all talking about it, and everybody's going to catch it probably. They were 4 times more likely to catch it than the common cold. But at the end of the day, there's not that many people really dying from it, at least at this point. All right, so theta is the impact of time premium. So we think about it, you can't cut back a day. So basically, theta is going to be a negative every single day. So tomorrow, these premiums, all else being equal, the market doesn't change by a penny. All right, we are going to basically subtract 29 cents from all of the premiums. Then 28. You can see theta is going to affect the premiums closest to the at the money than the ones that are deep in the money or further out of the money on the calls. And same with the puts. You can see that starts decreasing the further away. So we have to be very aware of theta on our premiums. Now, keep in mind, we go out here 100 plus days, and you can see that theta is about half. So a lot less. And this is on a high price stock. So think about theta eating away at our premiums. Well, we want to buy these long calls, right? So we want to minimize this theta. So think about it. We want to get further duration. Yes, you're going to have to pay a little bit more, but you are giving yourself more time to be right the further out you go, and you're going to minimize this thief. Think of theta is the thief in the night that comes and steals your premium, right? We've got delta, that is data. Gamma goes with delta. Theta is the thief in the night, right? And vega, vega is just volatility. Right? I don't have a witty one for that. Maybe victory, if you play it right. But vega measures the change in volatility on our and affects our premiums. So volatility, we got to think about this. This is a plus, right? Every 1 percentage point increase over here. So vega is in this column, and this is assuming every 1 percentage increase. So going from, let's just call it 45 to 46, then these premiums on the put side are going to increase on 1 percentage point, 83, 82 cents for 1 percentage point. All right. We could probably go and look at Netflix and see that it increased, the volatility increased by a couple of percentage points today, just today alone. I mean, you can see that spike. Everything's going to all-time highs on their volatility coefficient. But, you can see that was probably, we could call it almost 5 percentage points. It's hard to tell on the charts, but, how many exactly it went up today. But, if we called it 5 percentage points, we're talking $4 increase in these premiums over here. All right. $4 increase in these premiums. Like I said on the calls, you got 83 cents increasing, 4 percentage points, 4 times, or 5, let's just call it 5 because it's easier math for me. 5 is $4, right? Just better than $4. Well, this moved $7.83. You could see that basically that volatility adjustment offset the delta, right? So if this went down by $7, 7 times that is $3.50, let's call it, maybe a little bit more than that, $4. And then this increased with that volatility adjustment by $4 as well. So that volatility adjustment offset the delta move, all right? I'm getting a little bit highbrow here. Some of you might be getting lost, but if you think about this cognitively, we had a $7.50 move, and I'm just saying, I'm not adding in the gamma and all of that stuff. You can see gamma is quite little anyway on this product. But if we had a $4 move to the negative side, right, and 55 cents for every down move, I could do the math on it to get it exact for you. Let's just pull up the calculator. So I have a $7.50 move times 55 cents times 55 cents. And this is very rudimentary. You know what? Here, $4.12. We can do it like this. We can go to the theoretical. Let's just do that and reset this. Say we have a $7 negative move, and we'll just say it's from now, not 70. $7 negative move, and our price adjustment was 5 percentage points. 5 percentage points. Let's see what that does to the premiums. The mark, it's saying right here, that's saying basically, I don't know why the mark is saying, could be because it's after the close, but basically you can see it's calling the mark for some reason a little bit lower than where it is. The mark's supposed to be right in between there. Let's just say if we go 1 day, we add a day and see what that does. For some reason, why is this off like that right now? But anyway, you can see that it was basically offset. I could do it on the math. We got that $4 change there. Something's wrong with the way that this is calculating, and I'm sorry for that. So, and what did we say? We had a 5 percentage point increase. So 5 percentage points times that 83 cents equals $4.15. That's why those are offsetting. All right. So what am I getting at here with all of this stuff? What I'm getting at is we need to make sure we are accounting for implied volatility and when and where is the right environment for this, right? We can look at the chart here on how volatility is structured. Now, when volatility gets up at these highs, it's usually around the earnings, all right? Well, right now we've got a crazy market going on and volatility is going through the roof. People are going out there and buying puts like they're going out of style. Well, my thing is when they get to extremes, it is almost assuredly going to want to come back to normalcy as soon as markets start normalizing, right? So even if the market traded sideways and that volatility came out, we aren't worried about delta anymore because the market's completely trading sideways and that volatility just comes out. We can achieve profitability much quicker. So extremes, we would want to be selling premium. When they're at extreme lows, that's the opportunity to be buying it because volatility isn't going to work against us, right? So with that being said, we're looking at the long calls, right? So we're doing a long call webinar. And with that long call webinar, that means we're buying premium. We want vol to be low. We want extremely low volatility. We want that volatility to be at some of its lowest levels ever. Also, if we're buying calls, we got to be bullish. And you got to be very bullish, because remember, that thief in the night loves stealing premium from us option buyers, all right? If you're a seller, you kind of hired that thief in the night to come and steal your premium. But when you are a buyer, you want to hold off that thief. You want to get further duration where he's not so aggressive. And you need to be very bullish to make up for those moves that thief is doing. So you need to make sure that we're offsetting with a directional assumption to offset that thief. We need our delta to compensate us. So with that delta to compensate us, or volatility, we could even have volatility start spiking. This market trades sideways. Delta's not helping us, but we've gotten ourselves into a situation where volatility is extremely low. And if it starts going up, then it will help offset that thief in the night. So one of the things we need to look at when we are looking at I see a couple of people talking about on home quarantine. I'm on home quarantine. I never go anywhere because I trade from home in my office. As long as my dogs don't get it, I guess my family could possibly get it, bring it home and infect me. All right. So let's look at, it's going to be hard to look at this right now because when volatility is at extremes, right, markets are going to get wider. And the reason why markets get wider when the volatility spikes is because the guy who is trading these options or market making these options, you can think about somebody who is a designated market maker. And that guy he is mandated to make a bid and offer. All right. Now, free market price discovery, we're all in there trading and we're making markets a little bit better. But think about it as somebody who is a designated market maker who is really, maybe it's an algo. That person or machine needs to offset risk. It's not allowed to be as risky as what maybe you or I are able to do, where we can sell some short puts and just buy calls. It's trying to offset its risk. It's trying to create arbitrage or find arbitrage and things of that nature. So if it, in this situation, is going to sell me the calls I want to buy, then it is going out and like buying the underlying, okay? It's trying to lock in a spread in a sense. So think about it as a spreader. He's got to go and run and try and trade something else against it. Maybe it's a different option, creates a spread. All right. Market makers, that's what their job is they don't want to really take risk. They want to offset that risk and create arbitrage or create a spread. All right. So in the time with this kind of volatility, with the markets moving, I mean, we could see from 12:30 to 12:30 East Coast, I think it was, basically to the end of the day, the market just sold off. So, in that time, there was a big move. Well, when that big move starts happening, he's got to make his markets wider because he's got to try and run to get that other trade off before it moves too far. All right. So you can think of it as when volatility is really high, you are also going to see the markets get a little bit wider. But we will take a look at, let's just say TLT for that matter. Any stock during open market operations, what we want to do is if it's over $100, we want to move the decimal 3 ticks to the left. And we want our markets to be about 15 cents wide. You just move the decimal 3 ticks to the left, that's 15 cents. And during open market operations, you want to see these markets about 15 cents wide, all right, just out of the money. You can see none of these are fitting it. For one, it's after the market. 2, we are seeing extreme volatility going on across the board. Deer usually is pennies wide. And we'll see that these after the market are, dollars wide. Why? Because nobody wants to leave their orders in there going into tomorrow, right? Everybody's canceling orders. They're not taking that risk overnight. So after open market operations, you can see that those are getting really wide. So again, these should be about 16 cents wide. We would probably even see Apple being extremely wide. That's, we would expect 3 ticks to the left, 27 cents wide. And you can see these are like almost $1. This is almost unheard of for markets in Apple. But rule of thumb, look at that. Anything that is less than $100, we need it to be less than 10 cents wide or better. Okay, so if it's greater than $100 stock, then we do that, move the decimal. So if it's, let's say it's a $200, XYZ is $200, we move that decimal to there, from this point to there, and we would say it's need to be equal to or less than 20 cents, all right? And if it's less than $100 stock, less than $100 stock, we need to be equal to or less than 10 cents wide, all right? General rule of thumb there. You can kind of squeeze on this, like right now, less than $100 stock and 15 cents wide. I'd still say that's a green light. Normally speaking, I would say that's probably a yellow light and proceed with caution. Same for this, I'd almost say it's probably, you could throw an extra dime on there for the way that the market's been reacting right now. All right, the environment. We need this environment. We need an IV percent of less than 50. All right. Now there's almost no stocks in my watch list that are less than 50 right now. So it's a hard nut to crack right now on buying a long call. Hard case for me to say, yes, tomorrow I'm going to go out there and buy a long call to give you guys the example of how we implement this. And that's what I usually do in these daily market commentaries that I do every day. The day after, I usually find a stock that I am going to implement that strategy around. I can create a bull or bear case for anything. I can Activision, Activision's only one I can think of it right offhand. But if everybody is home quarantined, like Robert's saying he's doing, then Activision is really going to go through the roof. Everybody's sitting around playing video games. Facebook, another example, right? They don't have a lot of exposure to China. And if everybody's sitting at home Facebooking, well, shouldn't Facebook be doing well? So there's always an opportunity. I can always find a bull market for something. But Facebook, it's not fitting these parameters. So as a matter of fact, I sold puts in Facebook today. I'd be happy if there's a big correction in Facebook again. And if somebody put me the stock, then I'd be happy to do it at the level I'm at. It's a massive drop from where we currently are. So, we've already had a 10% correction, and, that's, in my eyes, a little overdone. So we need to find something with an IV percent of less than 50. And there is, I think, 1 or 2 on my watch list. This is my watch list. See, I got IV percent over here. And basically what this tells us is where is implied volatility in relation to where it's been in the past. You can see it's at 100%. Now, tomorrow, volatility could rise even further. It's still at 100%. That is one of the flaws with this. But you can see, generally speaking, this is a black swan event, if you will, where it's not going to happen, time and time again. You can see that, generally speaking, that volatility for Apple usually is above, or anything above 37, 38 is high. All right. And, I'll talk about this going forward, especially in the daily market commentaries, when this comes back down from the stratosphere, that how we will play that. We're going to have to possibly discount that black swan event going forward. So we're going to need to know what this problem is, or what the mathematical equation is that we come up with for this. And what we do is we take where current implied volatility is now and subtract it from the low and then divide that by the high minus the low. Now you can see that that's going to equal 1, right? We can say 50 minus, let's say 19, 50 minus 19 divided by that, take that sum and divide it by the high, which is 50 minus 19 equals 1. So that is 100%. So right now we are currently at the highest level. But let's try and find something that's not quite like that. Let's just take GE, for example. In GE, we can see the spike here was at 80, what is that, 81, all right, is the high. We need the current, which is 57, and the low, which is 32. So what did I say? The high, what was the high? 81. So we need to know for the implied volatility, current IV minus the low IV, and divide that by the high IV minus the low IV. All right. So, and it doesn't mean once it's at 100%, it's not going to go higher, but you can see that usually, all things being equal, they usually stay in a pretty good range. So we've got the current IV, which was 52, minus the low, which was, I already forgot it. I remember the top one was 82. The low was 31, 32. Let's just say 32. 32, and then we take that sum and divide it by the high, which was 80. Let's just call it 82 for math, minus 32, which is the low. And then we basically subtract those two, and we get 20 divided by 50. And obviously the way it's probably closer to 48, but basically that's putting me at the 40th IV percent, okay? So a little bit low than what we were talking about with the actual numbers, but you know, if that's how we would do it. Oh, 57, is that where I went off on this one? 57? Okay. Well, if we were to use these numbers, let's just say we use those numbers, and that would have given us for XYZ then. All right. Would have given us about an IV percent of 40. All right. And we're looking at anything less than, so if XYZ was in the 40 percentile, then, you know, that would be an opportunity where we would be able to buy the long call because it's less than an IV percent of 50. So we'd be able to do that one. All right, duration. I kind of mentioned this. I mentioned it before. Remember when I was talking about theta? If we go over here and look at theta, now theta right now for GE, you know, it's a penny out here. It's probably going to be a penny out here because the stock is so cheap. There is no theta. There is a little bit of theta there, but it's all about rounding. We can look at something. Let's look at something that's going to have some good theta in it. Tesla, for instance, down $100, taking forever to load all of this information. You can see it with theta, 22 days to expiration. Tomorrow, these are going to be less $1, all things being equal. Nothing else changes. These premiums are going to be worth $1 less. Now, if I go, excuse me, out, you know, 100 plus days, it's only 50 cents. So it's about half. You know, yes, we could go out the 300 plus days and stuff like that and see that theta is much less. Theta, like I said, further out the curve is much less aggressive. But, you know, we're also talking about premiums that are astronomical that far out. I don't want to put that much money out there. All right. So usually what I'm looking at with this one is, you know, about 100 plus days to expiration, 95 to 100 days. Usually I say about, you know, 95 plus 95 days to expiration. You know, because we get out here, you can see that this curve, and these are for the at the monies, you know, we are going to be doing very close to at the monies, and you can see that this would kind of level off even further. Reason why we don't want to get that close for that first one, look at this kind of theta to drop. Yes, he gets extremely aggressive heading into expiration. So we want to stay away from this. We want to get outside of, this area here. We want to get out there, right? So try and use the options that are further away. Yes, you are going to have to put up a little bit more money for those, but you're also, for one, you're giving yours enough time to be right. Remember, you have to be extremely bullish with this one. We want to limit theta decay. Volatility affects further duration options more than the nearer duration options. I don't know if I mentioned that earlier when we were doing it, but we'll take a look at theta. So theta way out here is 50 cents. Now, if I go into those options that are inside of 20 some days, wait, what did I say? Volatility. Vega. Sorry, let's look at Vega. 72 cents on these. All right. If you go way out here in time, we're looking at $1.50. So Vega volatility affects the further duration. So we're putting all this together, right? Delta, it's not really, it's not going to impact our premiums really much differently, okay? Gamma, it does shorten up a little bit or gets a little bit less, but not enough to really call home about. The real ones we're looking at, theta. Theta further duration doesn't affect us as much. Vega, the further duration, helps us, especially if we're in low implied volatility. That's why we're trying to pick that low implied volatility market, because when that volatility expands on a move, it will help us. And if we buy it when it's really low, we could see that, usually it has a floor and a ceiling. You can't just look at volatility as volatility, because 83 doesn't really tell us anything. If I go to the charts, 83 doesn't tell us anything, because look, implied volatility for this can go up to 118%, right? If I look at eBay, 36 doesn't tell me anything, because 36 might be the high and it could be the low. Like if I looked back at Tesla probably never gets below 37. That's probably its lowest. So you can't just look at this number and say, well, 95 implied volatility is high. No, well, it might not be. DAL is going through the roof because the airlines are just getting crushed. I mean, I bet DAL, you put this on a 20-year chart, it might not even, let's just go 3-year chart. You can see that is the highest volatility. I can't pull up. I don't have them any longer than that, but that's amazing. So, 60 doesn't necessarily tell you anything other than right now, if you put that in the mathematical equation, you can see that that's extremely high. All right. Even during some crazy times, it doesn't get that high. Again, we can go and look at, let's say, Lulu. Lulu, you can see, is very, much in line with, it really spikes normally during its earnings. We are at one of the highest areas for its even earnings, but you can see that volatility has a tendency for each underlying to stay within a pretty good range. Yes, there are black swan events, especially for like biotech and stuff like that. Those will, for times like coronavirus or drug trials, they will see spikes outside of even normal earnings areas. But the idea here is we sell premium when it's extremely high for itself, or buy it when it's extremely low for itself. So you could see that if Lulu had an implied volatility percent of around 19 or 20 or even 30, close to 30, that would probably be an opportunity to where we would be thinking that would be a buying premium opportunity. Because if volatility expands, I already showed you, you could be directionally wrong, and if volatility expands, then that will help you offset that directional assumption that you were wrong on. All right. So, and think about it. When you're buying or selling stocks on any given day, your probability of success of having that directional assumption right is about 50%. So we want to kind of get away from that. Excuse me. All right, so strike location. This is really important. You know, I mentioned this at the beginning. A lot of people just recently reached out to me about why do I pick my strike location? I'm looking here. I look at about a 45 to a 35 delta. All right. And personally, I usually look at the 35 delta. All right. Why do I pick that? I'm usually in this for a short term. I'm looking at a market to come up and like pin a location or something like that. I'm looking at it to come up and hit my strike is what I'm looking for. I think, you know, this is my target. That line has nothing to do with like a Fibonacci or anything else, but I'm thinking, you know what, I think it's going to go up to that strike location or whatever. And, you know, I have a 35% chance of it going up there and hitting it. You guys might be thinking, well, that's pretty low. But remember, delta tells us that is the probability of that strike being in the money on the final day, that very last day, by 1 penny. Okay? So the probabilities of me being in the money at expiration by 1 penny or more is only 35%. But 2 times the delta is your probability of being kissed. So there's my lips for you. 2 times probability of being kissed is what we used to say on the floor, or being touched. You know, come up and hit there. Market comes up and hits my location. Yeah, it might come back down again, but I've got a 65%, or actually 70% chance. 70% chance of the market coming up and hitting that strike and maybe not finishing in the money. There's only a 35% chance of it finishing in the money, but I'm looking for it to come up and hit that mark, and I'm pretty much looking to get out at that point, is usually what I'm doing. So if we look at this, why wouldn't I pick the ones that are, you know, slightly in the money? Well, we can take a look at it. Let's find something that's close to like $100 just to do math a little bit easier. And I'm not going to look at, you know, the bid offer closest to expiration. You know, I would move the decimal 10 cents wide. We can see they're over $1 wide right now after the market. So what we're going to try and look at here, and hopefully my theoretical thing will work here. We're going to look at these in the money. Some people will say you buy these ones that are just slightly in the money, 55 to 65 delta. The reason why I don't like this is because the in the monies, remember I said you only have a 50% chance of picking your direction right. Okay? So these in the monies have intrinsic and extrinsic value. A little hack is to look over here and see about how much extrinsic value is. So they got about $3 and you know some odd cents in intrinsic value or extrinsic value. So that's theta decay. That's what's going to decay out of these. And then the rest of it is intrinsic value. So from $100 to 102, there's only $2.74 of intrinsic value. That's what these are worth. These 100 calls are worth $2.70. So, $2.70. So the rest of it, you know, that other $3.50 or something is extrinsic value, all right, or theta decay, what you could lose. So if I'm directionally wrong, I'm not only losing, you know, the directional deltas and all of that, I'm also losing the value of the intrinsic value, all right, what it's actually worth. So why wouldn't I pick the ones that are just out of the money, the 45 or the 35 delta? You know, I'm only paying for extrinsic value. Yes, I could lose all of that if I'm directionally wrong, but I'm not risking, you know, all of this if I'm directionally wrong. Okay, so think about it that way. You know, you're risking a lot more here I'm risking a lot less. Well, you might say, well, you're not getting the reward on the same move. But let's take a look at that. So theoretical, please work out for me. Let's reset it. I'm going to just give it 1 day of theta decay. So hopefully, all right. So this is saying the mark. I don't know why this isn't working these days. These should be exactly the same right now. Let's see. Let's just go up 1 day. Still off. I need to fix that. I'm going to have to reach out to him. Anyway, so let's try and keep this apples to apples. And I am working on strikes. So let's just say nothing else changes. We don't have any days move, but we've got a, let's say I'm looking at the 35, 45 deltas. Let's just say I can throw up the delta. So let's look at the 52s and let's just say the 48s. Actually, let's go with the little bit more dramatic. It's going to be a little, it's going to move at about the same. So I'm going to go with the 65 and the 35s. All right. So we're going to be looking at the 100s and the 106s. All right. 100, 106. So if I go and do my theoretical move, and let's just say we have nothing else happens, but I get a $10 move. Does that sound fair? And this is over the, actually, let's go further out. Let's see what happens out here. And we're going to look at, let me do this again, gamma delta. So let's look at the 60s and the 35s. Much rather have the other ones, but 60s and the 35s. So we're still looking at the 100s and the 110s. 100 and 110s. So let's just say that we have that same $10 move over the course of when we put this trade on. So we get a $10 move. We didn't go back in time. Maybe that's part of the problem, is it was trying to go back in time. So the 100s and the 110s, and over the course of this, we were expecting it to come up and hit 110. Now, you can see that the mark from here was $3.65. It goes from $3.65 to $8.34. I would have expected a bigger move than that. The 100s go from $8. This is ridiculous. $8 to $15, which is actually, it's going to be closer to $10 to $15. So you can see that these really increased by $5. Yes, you made some money on that, but look, mine increased by about, we'd have to say this was $5, by $3. So in percentage terms, you can see that mine went from $4 to $8, or $5 to $8. I increased by $3 there. That in percentage terms is much better. I don't know why this isn't working with these wanky markets. Let me try and find an ETF and see. I'm annoyed that this isn't working. Let's just look at the Qs. All right, so let's look at the Qs because they should have some tighter markets here at least. Yes. All right, so the Qs, let's reset this. Hopefully this isn't going to throw off the algorithm that that's looking at these numbers. So the Qs, we're going to look at the 194s. Let me write this down so I don't forget. The 194s, which is the 65s, and then the 35s, which is going to be the 218s. Okay, so now again, we get the $10 move, theoretical price. Let's hope that this works. So make sure that these are all inside of there. They are. Okay, so we were looking at the 94s right here. Theoretical is right in between. That looks pretty good. Now we get a price adjustment of, say, that $10. Same $10. All right. So those 194s went up by from 19. Okay, it stayed the same. 19 went up by, let's call it $7, just to round it off. Now mine, which were the 218s down here, were $6.30. They went to $10.38, right? So I got a $4 increase here. I only risked $6. Down here, on those that were in the money, 94s, I had a $7 increase, but risked $19, right? So you see how that risk reward is better without me having to do all the math. I mean, that's pretty obvious, right? I risked $19, almost $20 to make $7. And down here on these 118, they aren't even in the money really, right? But I'm only risking $6 to make $4. So much better risk reward, especially if you're directionally right. If you're directionally wrong, then you risked, a lot less as well. And that will play out the further you kind of look through that. Yes, I am cherry picking a directional move that moves in my favor. And, I can throw out theta and all of that stuff. But I'm just trying to get you the idea of risk reward. Yes, theta is going to pretty much be relatively the same on these ones that are in the money. The 65s, they're going to have the theta of 6 cents. Those 35s are very similar, right? So the theta is going to be very similar. The vega, the volatility on these 65s versus my 35s is going to be very similar. The gamma. All right, so those 65s and 35s are pretty comparable. Am I right? I mean, you guys can agree with that, right? So we're strictly looking at the risk reward. Yes, the directionality of my thing, I picked $10. Well, I'm picking a strike that's still out of the money. I'm trying to isolate volatility and theta and all of that stuff. So the risk reward on this trade is much better by far. Okay. So that's why we would want to pick the strike locations that are out of the money, that 45 to 35 delta. If I went a little tighter and looked at like the 50 delta or 55 delta and the 45 delta, you would see a very similar situation. Like these increased by $6, but you're risking $15, and the ones that are closer, $12, but you made $4, right? What would you rather do? All right. Does that make sense for everybody? All right, so exit strategy, guys. Couple of things. We have to remember, we have to be bullish as a matador, and it was what we used to say on the floor, and mad being you have to be crazy bullish. And right now, probably a lot of people aren't, but it's also, you guys, right now is not the opportunity to be putting on the long calls, because we start getting a bounce or a V-shaped recovery here. It could hurt you with this volatility coming out. So maybe right now is not the right time. We just need to know this for when volatility is relatively low and we have a trending market, we get back into a bullish trend. That is probably the time. Right now, the time to really think about it is go back and look at my short puts, especially if you have a portfolio where you're thinking, I think it's a good location to buy down here. We've had a 10% correction, things of that nature. Check out that webinar as well. But your exit strategy is when it comes up and hits that 35 delta. If market comes up and kisses you, get out, all right? And if you're used to trading with Fibonacci's and stuff like that, when it comes up and hits that resistance area, that's where you want to get out. I always write it down. I say my exit, I write all these things down. I'm telling myself, all right, AAPL, I'm doing that. The environment, the IV percent was equal to, 10, right? The duration, I'm picking the 122 days to expiration. A strike location, I did the 35 delta. My exit strategy is when the Apple is you know, hits, strike. All right. And I write this stuff down. You know why? Because if you don't write this stuff down, you don't hold yourself accountable, really. And you will bend the rules, and you'll have a tendency to be like, oh, well, you know, it hit my 35 delta. I'm going to squeeze it out for a couple extra ticks. Well, what happens? It goes up there. That's where your 35 delta strike was, and boom, it comes back down. All right. So pick your location and get out. Stay mechanical. This isn't something that I usually stick with for the long term. Now, if you're in something for the long duration, you want to trade this out for and hold on to it for a year, then go out further duration, pick that, 350-day strikes and hold on to those calls for the long duration. I'm looking at this for more of a trade and hitting my deltas, all right? I'm looking more at this as the short-term trader, okay? If you're a longer duration trader, yes, then go a little bit further out. I'm not usually in anything for longer than 100 days or so. So, but if you want to hold on to this a lot longer, no, you are not going to get a dividend for being in it. But think about it. You're also only using about a quarter of what it would cost to go out there and buy that underlying, okay? So yes, you aren't going to get a dividend, but you also don't have to have the kind of capital in order to get the same type of trade out of it. And also we have to be very aware of dividends, okay? Because it is assumed on the ex-dividend date, ex-divvy date, all right, the stock XYZ is expected to drop by the amount of dividend, all right? So ex-dividend, it is expected to drop by that dividend, right? So keep that in mind going into it. I wouldn't say buy it like 3 days before that ex-dividend date. This is only in theory though, okay? This is a theory. It doesn't always work. It is expected to, because if I buy on or after that ex-dividend date, I don't get that dividend, all right? So the reason why they do that is because the accounting, they can't figure out who's buying and selling these fast enough in order to pay you that dividend. So ex-dividend date, you don't get that dividend, so I'm expected to be compensated for it. You see stuff like Apple, it will rally on those ex-dividend dates and doesn't matter. So it's not always going to definitely happen. All right. Your max profit on this trade is going to be pretty much unlimited, you guys. If you started buying, calls when on any given date and the market goes to the moon, in those next 100 days, then, it's considered unlimited, but we know we're going for our strike location. All right. Our max loss is that premium. That's why we're picking that 35 delta and not that 65 delta. All right. We don't want to risk more than we have to, right? And if our risk reward is much better by picking that 35 delta, go with that one, cost you less. JQ, I see something getting thrown up there. Let me get out of the way real quick, and then I'll answer that question. Break even is that long option plus the premium paid. And this is at expiration. This is on the day of expiration. So if I pick the 100 strike, okay, I picked the 100 calls and I paid, say $3. I had to pay $3 debit. All right. Well, my break even is what? 103. 103, sorry. All right. So my break even is 100. That was a total $103. Okay. So our break even is the strike plus that premium paid. You will see this, as for every dollar it goes up, my premiums are going to increase as long as I'm in that duration. Theta is going to start really eating away at everything. So that is at expiration. I need to be at $103. But, I said as soon as the market comes up and hits my short call or my long calls, that's where I'm getting out. If you're looking at just getting in and out, why not buy the current weeklies? Because of that theta decay. Remember I showed you that theta decay? It's like 3 times as much. And if I don't get that move right away, I'm giving myself the more duration to be right. If it doesn't happen like today, or in the next 3 days, then I'm giving myself the opportunity to be right, because I know that I might be wrong the next few days, because my probability of picking the exact right time, picking the bottom and the market immediately goes higher afterwards, or picking the perfect timing for the market to start rallying, is only 50%. It's like flipping a coin. But when I give myself the opportunity to stay in this trade longer, and remember, theta decay is less the further duration out. That thief doesn't steal as much of your premiums. And 2, if volatility goes up, it's going to, it impacts my premiums more the further duration out, all right, than the ones that are closer to expiration. So I want to try and set myself up for success. And by doing that with a long call that has a lower probability of success, then how do I increase those probabilities of success in my favor? Well, I give myself, if it's a low probability strategy and I only have about a 50% probability of picking the right day that this is going to start moving in my direction, then why not give myself enough time to be right? 2, theta further out in that duration isn't going to hurt me nearly as much. It's probably going to hurt me about half as much, all right? And volatility is going to help me almost twice as much. So all of those things, that's why we're picking that further duration out. In a fast moving market like today, deep in the money options, no, because even the deep in the money options, Amaro, you're going to be risking a lot of money. Plus, when you go deep in the money, we saw how those ones that are at the money, and those are the ones that are having the most volume and open interest, those are the ones that are trading the most, the ones that are at the money, those are expected to have the tighter markets. Deep in the money, those, yeah, you're going to get a lot if you're directionally right, dollar for dollar, because the delta is going to be helping you, but you're risking a ton of money, all right, if you're directionally wrong. Okay, so I'm telling you guys, the 45, 35 delta, bang for your buck, is the best I found option to trade, in my opinion. And when I showed you on that theoretical move, you could see that your risk reward was much better with that 35 delta than the 65 delta. And if you went to the the 95 delta, you're going to see that, yeah, you aren't risking a lot of theta decay. You don't have to worry about that theta decay. But if you're directionally wrong on a day like today, you're going to get crushed. Right? That makes sense? All right. Any other questions real quick? All right, you guys, I'm throwing a link into the chat window over there. This is our new premium options education service. I'm going to have all kinds of stuff going on with this. Try and stay with it. Like I said, the link is in the chat window. If you're watching this on tape delay, it's in the red. But basically, this is a full education service, and you're going to get the daily market commentaries, trade analysis that I find when and where I think that those things are appropriate. Keep in mind, you need to take your own risk parameters into account and follow along with that, so that you get that 50 videos for trading workshops, premium access to the trading webinars like what we're seeing here, the live trading courses, and premium membership option trading courses. All of those things. It's basically for $97 a month. You get full access to me, where I will answer all your questions when, where, and why I think it's appropriate. And you can reach out to me about a trade that you have, and I will give you my opinion on it. You're going to get the options classes for beginners. You're going to be able to take options for intermediate. You're going to have a master's degree almost after this. I can't really give you a master's degree, but that's basically what all of this is going to be. And it will roll out advanced traders. Basically, you can go all the way through this. We're walking you through from the very essential beginning to the very end of what you would need the most. It's going to ramp up your risk parameters and everything. So all of that you can add it to your cart for $97 if you click on that link. Otherwise, you're going to have to punch this stuff into your URL to take advantage of it if you're watching it on tape delay. But I mean, tons and tons of courses going on here that you guys can take advantage of. All right. So basically, we're walking through the very essentials all the way to some of the really dynamic option classes that will build you up to that. So by the end of this, you will literally be able to talk to anybody. You'll be able to watch TV and get disgusted with those guys with some of the options trades that they're doing. You look like quite a I don't even know what that word is and how to pronounce it, but in that picture, LOL. Yeah, I get a little dramatic when I'm on online and talking to the camera, which you guys can see on the daily market commentaries. I have the camera going during the daily market commentaries. All right, other than that, I want to thank you guys all. Later webinars, I'll be drilling down on different option components, when and where I find those appropriate. There again is the link for this course. If you're watching on tape delay, you got to punch it into your URL. And easiest way to do is chat. Hit that chat window. We'll take care of you. Like I said, you have unlimited access to me. Day or night, you can email me or give us a buzz at 310-598-6677. All right? That's all I got for you guys. Take care, everybody. And if you can't take that, take it easy. Take care, guys. Thank you guys all for the kind words. Appreciate it. And make sure you guys take a moment to pause and go over our disclaimer.